What happens when one of our biggest trading partners hit us with a 10% tariff on almost everything we sell them, plus 25% on our cars? Hello and welcome. Today we are reviewing Trump's so-called Liberation Day tariffs and explaining exactly how these new US import taxes could shake up UK businesses, your shopping costs, inflation, and even our country's economic growth. We will lay out all you need to know, from jobs at risk to the threat of a broader trade war. But still, a lot of things need to be clear, especially the UK government's outcome of negotiations with the US about trade tariffs. What is Liberation Day? On 2nd April 2025, Trump declared Liberation Day, claiming it as America's economic independence. Essentially, he introduced a 10% blanket tariff on all goods entering the US, tripling the previous average US tariff rate. Additional reciprocal tariffs on countries he says have been giving the US a bad deal. For the UK, that means 25% on car exports and a baseline 10% on everything else. Trump says this will bring manufacturing back to American soil. Critics and the markets fear it is the start of a global trade war. Stocks dropped and experts warn of a chain reaction affecting jobs, investment, and prices. So how does this affect us here in Britain? The UK impact, an overview. The UK is not spared, although we got off more lightly than the EU, which faces a 20% tariff on most goods. Here is the breakdown for Britain. 10% tariff on UK goods. Every single product we ship to the US, whether it is machinery, pharmaceuticals, or Scotch whiskey, no cost and extra 10% for American importers. 25% tariff on cars. Our automotive sector is hit even harder. The US is the UK car industry's second largest export market, so those taxes could really hurt demand for British cars. Knock-on effects. This is not just about exports. Reduced sales abroad can mean less production at home, fewer jobs, and potentially lower economic growth across the board. Let us dive deeper into how this might influence our businesses, consumers, and ultimately our economy's big indicators like inflation, interest rates, and GDP. UK businesses and consumer market. Car makers, Jaguar, Land Rover, Bentley, Rolls-Royce, Mini, and Aston Martin all rely on the American market. If they pass their 25% tariff on to US buyers, some customers could opt for cheaper alternatives. Especially for mid-range models, luxury brands might survive if wealthier Americans absorb the extra cost. But any drop in US sales can lead to cuts in production back here in the UK. That in turn could hurt jobs from Sunderland to Solihull. Other exports, pharmaceuticals, car parts, whiskey, textiles, everything faces a 10% markup. Smaller firms especially might struggle to stay competitive if they can't quickly relocate production or swallow costs. UK businesses may explore new markets or invest in US facilities to bypass tariff, but that require time and money. Consumer ripple effect. When businesses start hurting, they hire less and might freeze pay rises. That can lead to lower consumer confidence. People spend less if they worry about layoffs. Plus, if US buyers start avoiding British goods, demand dips and we see downward pressure on growth in our biggest export sectors. The result? Potential income hits and job uncertainty for those working in export-reliant industries. Inflation, interest rates, and GDP. Now let's talk about the macro picture. Inflation, interest rates, and GDP. Inflation. Tariffs can push global prices upward. If other countries retaliate, trade routes scramble and supply chain costs go up. A weaker pound because investors might see this as risky, can also make imported goods like electronics or certain food prices costly. That means inflation could rise for us here at home exactly when the Bank of England is trying to keep it down. Interest rates. Higher inflation often puts upward pressure on interest rates. If the Bank of England believes inflation is heading above its 2% target, it might decide to raise rates to curb spending. Higher interest rates affect mortgage repayments, credit card costs, and business borrowings, potentially slowing down the economy. GDP. Remember, exports are a core component of the UK's gross domestic product. If American demand for our goods tumbles due to higher prices, that directly reduces GDP. Some economists say if these tariffs persist, UK growth forecast might be revised downward. We could even face stagflation, that is, rising prices and stagnant growth, a worst case scenario for any economy. We are not there yet, but these tariffs have introduced an unwelcome headwind for an economy already juggling post-Brexit trade transitions and cost of living pressures. Job market and demand. Demand for UK exports drives jobs in manufacturing, shipping, and related services. Take the automotive industry. Tons of thousands of people are employed directly on assembly lines and even more indirectly. Think parts suppliers and service providers. A 25% slump in US demand could mean production cuts and eventually layoffs or fewer new openings. Meanwhile, less demand abroad can ripple through local economies. People with insecure jobs spend cautiously, which can cool the domestic market. Over time, if tariffs remain high and no new trade deals are reached, we could see structural changes like companies relocating production or the UK government stepping in with support packages. But either way, job uncertainty might outweigh heavily on consumer sentiments here. Government response and trade talks. So, how is Westminster reacting? Prime Minister Keir Starmer's administration has so far avoided a tit-for-tat tariff on American goods, citing the close UK-US relationship. They are negotiating behind the scenes, hoping for special exemptions, particularly for crucial sectors like automobiles. A UK-US free trade deal is suddenly back in the spotlight. If we can hammer out an agreement, it might remove or lower these new tariffs. But that won't come easy. Washington may demand more access to UK markets, including sensitive areas like agriculture and healthcare. Plus, the EU is threatening its own tariffs, which the UK may or may not join. It's a high stakes dance that needs careful balancing to protect British interests. Future outlook. What next? It depends on how long Trump's tariffs last and whether global players keep escalating. We could see a quick deal if the US sees economic strain from global retaliation. Maybe Trump softens a prolonged trade war. More tariffs, higher prices, and slower growth all around. Supply chain shifts. UK firms might move operations to the US or diversify exports away from America. In any scenario, we are looking at serious uncertainty for UK businesses, the job market, and overall economic stability. Diversifying trade partners, forging new agreements, and maintaining strong ties with existing allies will be crucial. It is real test of the UK's resilience post-Brexit. Ultimately, Trump's Liberation Day tariffs pack a punch for the UK. A 10% blanket tariff plus a 25% car tariff could dent our exports, threaten manufacturing jobs, fuel inflation, and weigh on GDP if they stick around. while immediate price hikes at your local supermarket aren't guaranteed. The ripple effects, especially if a trade war escalates, could absolutely shape Britain's economic landscape. What do you think? Will Trump's move force fairer trade or spark a damaging global standoff? Let's know in the comments below. Don't forget to ring the bell to stay updated on the latest developments. Thanks for watching and see you in the next time.